I am speaking directly to modern investors. The venture capital world is fundamentally broken. Traditional VC forces investors to accept massive risks with no protection while locking capital for decades. Founders surrender control to funds that may not share their long-term or adapting vision. The system works for almost no one except the lucky few. The problem: you face an impossible choice. Accept boring 3% returns from safe investments, or gamble on startups where 70% of investments fail completely. Traditional funds lock your money for 10 to 15 years, with zero visibility or control over investment decisions. The solution: the VC risk swap completely redesigns startup investing. You get high-growth venture returns with insurance protection against losses. Payments spread over 5 years instead of upfront commitments. Complete transparency into investment performance. This is venture capital rebuilt for modern investors. You've built significant wealth through smart decisions. Stock markets offer diminishing returns, while inflation erodes purchasing power. You want startup excitement and returns, but understand the massive risks involved in traditional venture investing structures. The problem: venture capital funds lock your money for a decade without any input on investment selection. You can't see portfolio performance until it's too late. Fund managers collect fees whether you profit or lose everything. You're writing blank checks based on trust alone. The solution: the risk swap lets you invest directly in companies you choose. Spread funding over 5 years as companies hit milestones. Get regular performance reports showing exactly how investments develop. Insurance protection covers downside risk while preserving upside potential. This is institutional quality investing with individual control. I am speaking directly to holding companies. Your company maintains millions in cash reserves earning minimal returns. Board members question why capital sits idle while inflation destroys value. You need better deployment strategies without introducing unacceptable risk to the balance sheet. The problem: cash reserves earn 2 to 3% in treasury bonds, while shareholders see lazy capital management. Investing in high-growth opportunities seems attractive, but explaining venture losses to your board would be catastrophic. You're trapped between dead money and dangerous bets. The solution: transform idle cash into protected growth investments through insurance-backed structures. The 5-year payment schedule aligns with corporate planning cycles. Successful investments convert to equity, capturing massive upside. Failed investments trigger insurance protection, preserving principal. This improves return on assets while maintaining prudent risk management. I am speaking directly to family offices. You manage multi-generational wealth, requiring both preservation and growth. Every investment decision affects multiple families, trusting your judgment. You cannot afford gambling, yet missing opportunities means failing your duty to grow wealth effectively. The problem: venture capital's 70% failure rate violates fundamental wealth preservation principles. Clients expect consistent performance, not lottery tickets. Avoiding startups entirely means missing economy's biggest growth stories. You're stuck between excessive conservatism and reckless aggression. The solution: insurance protection transforms risk calculations, enabling startup allocation without violating fiduciary duty. 5-year observation periods provide real performance data before equity conversion decisions. Protected investments with asymmetric upside satisfy conservative trustees while achieving venture-scale returns. This delivers growth while maintaining preservation standards. I am speaking directly to strategic corporations. Your corporation needs external innovation to survive disruption. The best technology emerges from startups, but identifying winners before competitors requires new approaches to corporate venture capital and strategic partnerships. The problem: traditional corporate venture means immediate equity positions, creating accounting complications. You might fund companies for years before competitors acquire them. Missing the next industry disruptor could doom your company. Binary equity bets don't match strategic needs. The solution: fund promising startups while securing technology licenses, partnerships, and acquisition options. 5-year funding provides extended due diligence, validating technology and market fit. Board observer rights create deep understanding before acquisition. Competitors cannot access your pipeline companies. This is paid innovation scouting with exclusive options. I am speaking directly to risk-averse angels. You're successful professionally and want to support entrepreneurs through angel investing. The idea excites you, but losing hard-earned money on someone's dream creates paralyzing fear about entering this asset class. The problem: traditional angel investing means writing $50,000 checks based on presentations and founder enthusiasm. Most angels lose money on most investments. Without experience evaluating startups, one bad investment could permanently sour you on angel investing altogether. The solution: commit funding spread over 5 years as companies prove themselves. Attend board meetings, mentor founders, learn startup operations during protected period. Insurance prevents total loss if companies fail. By conversion decision, you understand businesses deeply. This is angel investing apprenticeship with downside protection. I am speaking directly to strategic investors. The risk swap creates competitive advantages beyond financial returns. Your investment becomes strategic positioning that competitors cannot replicate through traditional venture capital or corporate development programs. The problem: passive LP investments provide returns, but no strategic value. Traditional venture offers no competitive advantages. You need investments that build moats while generating returns. Standard structures don't connect capital with strategic positioning. The solution: technology companies secure API partnerships before competitors notice opportunities. Manufacturers lock exclusive materials innovations. Pharmaceuticals control drug pipelines before valuations explode. 5-year relationships shape product roadmaps, introduce customers, integrate innovations. Capital blocks competitors while building strategic advantages beyond mere returns. Speaking directly to performance-focused investors, traditional venture funds need more than 25% gross returns just to break even after fees and failures. You can wait 10-15 years for distributions, with most capital trapped in losing investments. Try getting your money back from illiquid investments. The problem: VC funds charge 2% management fees plus 20% carried interest regardless of performance. J-curve effects mean negative returns for years. Power law dynamics require unicorn outcomes offsetting massive failure rates. Risk-adjusted returns remain terrible despite high nominal returns. The solution: insurance eliminates catastrophic losses, improving probability-weighted returns. No fee structure, draining returns. Investment decisions use real performance data, not speculation. Sharp ratios exceed traditional venture significantly. Positive return probability increases from 30% to over 70%. This is venture upside with investment-grade downside protection. Speaking directly to all modern investors, innovation economy needs your capital, but traditional venture wasn't built for modern investors. Legacy structures serve small insider clubs, accepting massive losses for occasional wins. You deserve better. The problem: current venture capital models create misalignment between investors, funds, and founders. You lack control, transparency, and protection while accepting enormous risks. The system optimizes for fund managers, not capital providers. The solution: the VC risk swap redesigns venture capital for you. Wealthy individuals get direct control with institutional protection. Corporations deploy cash strategically with safety. Family offices access venture returns, maintaining fiduciary standards. Everyone receives downside protection, payment flexibility, and superior risk-adjusted returns. This is venture capital evolved for modern investors. The innovation economy deserves capital structures matching modern realities, not 1970s relationship investing models. The VC risk swap represents fundamental financial innovation, solving principal-agent problems plaguing traditional venture while preserving equity upside. Whether you're a wealthy individual seeking portfolio diversification, a holding company optimizing capital efficiency, a family office balancing wealth preservation, a strategic corporate building acquisition pipelines, or an emerging angel entering startup investing, you get identical benefits: downside protection, deployment flexibility, strategic access, and superior risk-adjusted returns. This is venture capital evolved for 2026 and beyond.